Welcome to the deep dive. You look at a stock chart expecting rational math.
Right. Clean numbers and logic.
Exactly. But what you actually see is this chaotic, jagged seismograph. It looks kind of like a polygraph test for someone who is lying.
Oh, totally. It looks like pure noise to most people.
Yeah, but what if that chaos isn't random at all? What if it's actually a highly predictable map of human fear and greed?
That is the big question.
Today, we are decoding the 1948 playbook that took charting out of the shadows and, well, really turned it into a science. We are pulling from a summary of Robert D. Edwards and John McGee's foundational text, Technical Analysis of Stock Trends.
Yeah, the beauty of what Edwards and McGee did was take something viewed as a dark art,
Yeah.
something practiced by speculators in smoke-filled rooms who were just relying on gut feeling, and they codified it.
Right.
They completely stripped away the mystery and built a framework around human behavior.
Okay, let's unpack this because I always struggled with this premise. Fundamental analysis just feels so much safer. You look at a company's balance sheets, their PE ratios, the strength of the management team. I mean, that feels like real investing.
Sure, it feels grounded.
Yeah. Whereas charting just feels like trying to read tea leaves to predict the future.
That is by far the most common criticism. But Edwards and McGee offer a pretty harsh counter-reality to that.
Which is what?
By the time you, the average investor, see a glowing earnings report, the smartest, most well-capitalized players have already acted on that information.
Oh, wow. Like way before the public.
Weeks or even months in advance. The good news is already fully baked into the price before you ever even read the headline.
So is technical analysis basically less like a crystal ball and more like a real-time mood ring for the entire stock market?
I love that analogy, yes. It is the ultimate aggregator. A chart instantly synthesizes all fundamental facts, insider knowledge, panic, euphoria, and future expectations into one single equation of supply and demand.
Right, because if supply exceeds demand, prices fall. It's just basic economics.
Exactly. The chart doesn't lie because it represents real capital committed by real buyers and sellers. And since human nature really hasn't changed since 1948,
We're still greedy, basically.
yeah, we are still fundamentally driven by fear and greed. So the geometric patterns that track that capital, they repeat continuously.
But wait, 1948 markets were completely different. There was no internet, no high-frequency trading algorithms. How can patterns based on hand-drawn paper charts still apply to modern digital markets?
Because human hardware hasn't received an update.
Huh, right.
We still panic when we lose money, and we still get arrogant when we make it. The speed of the market has definitely changed, but the emotional reactions to gaining and losing remain identical.
That makes a lot of sense. So before we zoom in on the specific geometric shapes, like the actual words of this charting language, the text emphasizes understanding the broader market context first.
Yes, the macro view.
Right. And they pull heavily from Charles Dow for this. How does looking at multi-year trends help someone listening who's just trying to make a trade this month?
Because if you don't know the primary trend, you are trading blind. Dow Theory is the macro framework. You have to recognize that the market operates in three simultaneous movements.
Okay.
First, you have your primary trends. Think of these as the massive oceanic tides, the bull or bear markets lasting from 1 to several years.
The overarching direction the water is moving?
Yes, and within those massive tides, you have secondary reactions.
Which are what?
These are significant counter-trend pullbacks, like the waves crashing against the tide, and they last weeks or months. And finally, you have the minor trends. These are the daily ripples.
The day-to-day noise.
Exactly. The short-term noise that usually chews up day traders who lose sight of the primary tide.
So the source breaks down those massive primary bull tides into three distinct psychological phases. And the first one is the accumulation phase, which usually happens when the macroeconomic news is still incredibly bleak.
Right, when things look terrible. Institutional players are building massive positions during accumulation.
While everyone else is panicking.
Precisely. They're buying from panicked sellers who are capitulating because the headlines are terrifying. The smart money operates with a much longer time horizon. They step in when blood is in the streets.
It reminds me of like buying heavy winter coats on clearance in the middle of July.
Oh, that's perfect. Yes.
The general public isn't thinking about freezing temperatures at all, but far-sighted, courageous buyers are locking in those deep discounts because they know winter eventually comes.
That captures the dynamic perfectly. The smart money buys the July winter coats. As corporate earnings finally start to show actual improvement, you transition into the second phase, which is public participation.
Okay, so the public finally catches on.
Right. Prices rise steadily, trend followers jump on board, and it is generally the longest, most profitable stretch for the average investor.
But then things get dangerous in the final stage, right? The distribution phase.
Very dangerous. This is the excess phase. It's the mirror image of accumulation. Now, the news is spectacular.
Euphoria takes over.
Completely. Everyone is offering stock tips at dinner parties and buying into the hype. And the smart money that bought those coats in July,
They're selling them.
quietly unloading them at a massive markup to eager retail buyers who are arriving way too late to the party.
Wow. And a bear market follows that same sequence, but in reverse, eventually bottoming out in total despair. So if we know the market moves in these massive phases, how do you actually spot the structural moment when that distribution phase ends and a bear market begins?
This is where Edwards and McGee's anatomical breakdown of the head and shoulders top comes in.
The famous head and shoulders.
Yeah, it is the gold standard of reversal patterns.
Yeah.
Because it visually maps a complete, orderly transfer of power from aggressive buyers to dominant sellers.
Okay, let's trace the psychology of it for you listening. A stock has been in a long uptrend. It rallies to a new high, then dips as early buyers take normal profits. That forms the left shoulder. Then buyers surge back in, pushing the price to a brand new higher peak. That forms the head.
And keep in mind, up to this point, everything looks like a completely healthy bull market. Higher highs and higher lows.
Yeah.
Nothing is technically broken yet.
Okay.
But when the market sells off from that head, it drops all the way back down to the level of the previous dip. Connecting those two dips gives you your baseline, which they call the neckline.
But hold on, if everyone reading a textbook is watching for a head and shoulders pattern, doesn't it just become a self-fulfilling prophecy? Or, couldn't smart money just use it to trap retail traders?
That is a crucial point, and it's exactly why the formation of the right shoulder is the absolute linchpin.
The right shoulder, why is that?
Because it's not just a shape on a chart, it's a structural failure of demand. Buyers try to push the price up one more time. Now, if it were a trap or if the bull still had underlying momentum, they would blow past the previous high.
But they don't.
No, they don't. They completely lack the capital to reach the height of the head. The rally stalls at a lower high.
So it's sheer buyer exhaustion. They simply run out of ammunition.
Exactly. And when the price turns down from that weak right shoulder and decisively breaks below the neckline, especially if trading volume expands as it breaks, the psychology snaps.
The trend is over.
The bull trend is structurally dead. All those late buyers are suddenly trapped underwater, which triggers a cascading wave of panic sell orders.
The source also mentions secondary patterns like double tops and double bottoms, but Edwards and McGee give a pretty stark warning about double tops, don't they?
They do.
It seems like novice traders see two peaks and immediately short the stock, assuming a massive crash is coming.
And novices get absolutely slaughtered trying to anticipate double tops.
Wait, really? Why?
Because true double tops are exceptionally rare. For it to be a confirmed reversal, the price can't just stall at the previous high. It has to reject that high, fall all the way back down, and decisively break below the intermediate valley.
The lowest point between the two peaks.
Yes. Until that valley floor breaks, it is not a reversal. The market is just consolidating.
Okay, let's talk about that consolidation. What if the market isn't reversing at all, but simply stalling? Like, the buyers aren't exhausted, but they aren't surging either. Does the chart just break down?
Not at all. It forms a continuation structure. The market often has to digest a massive move before it can continue in the same direction.
So what does this all mean for the chart shapes?
This is where you see triangles, flags, and rectangles forming.
The text details symmetrical, ascending, and descending triangles. Symmetrical seems pretty straightforward. Price coils tighter and tighter with lower highs and higher lows until it violently breaks out.
Right, like a compressed spring.
Exactly. But the ascending triangle seems a bit more nuanced in its mechanics.
Oh, an ascending triangle is a fascinating look into institutional accumulation. You have a flat top, meaning a massive seller is sitting at a specific price, capping the advance.
Like a ceiling.
Yes. But underneath, aggressive buyers are willing to pay higher and higher prices on every single dip. They're constantly raising the floor.
So they're squeezing the seller.
Exactly. Eventually, they absorb all the seller shares and the price blasts right through that ceiling.
And descending is just the inverse, right? Sellers aggressively pushing the price down against a flat floor of buyers until it caves.
Yep. You got it.
But what about when a market is moving so fast it doesn't have time to form a big, drawn-out triangle?
Then you get a flag or a pennant. These form after near vertical price action. They're very short duration, maybe 1 to 3 weeks.
I picture a flag pattern like watching an Olympic sprinter running a marathon at a sprint pace. They are going incredibly fast, but eventually they just have to step off the track for a quick water break.
That's a great way to visualize it.
The flag itself is just a small, tight, downward sloping channel, while early buyers take some quick profits.
Right, but the key is that the market is so incredibly strong, the sellers can hardly push the price down during that break. It drifts lower on very light volume.
Just a mild pullback.
Exactly.
Mm.
And once the fresh buyers finish their water break and step back in, the price bursts out of the top of that flag and resumes the sprint.
And the source mentions the flagpole measurement rule for this, which honestly blew my mind. You can actually project a mathematical target based on the sprint.
You can. Edwards and McGee noted that flags generally form near the exact midpoint of a rapid market move. So, if you measure the vertical distance of the rally that led into the flag,
Which is your flagpole.
right, you can project that exact measurement upward from the breakout point. It gives you an objective, highly probable target for where the price is heading next.
Wow, you are literally quantifying market momentum.
Exactly.
So we've touched on these invisible floors and ceiling support and resistance. Anyone who follows the market knows the terms, but what actually gives those levels their power?
Human psychology.
Right, but why does a stock care that it bounced off $20 6 months ago? I mean, mathematically, it's just a number.
Because it comes down to market memory, fueled by two incredibly powerful human emotions, regret and relief.
Oh, this is fascinating.
Imagine you're watching a stock. It bounces off $20 and rockets up to 30. If you miss buying it at 20, you feel deep regret.
Yeah, FOMO.
Right. You tell yourself, if this ever gets back to 20, I am backing up the truck. I won't miss it again.
So the memory of the missed opportunity creates a physical barrier of limit orders. When it falls back to 20, all that pent-up regret executes, creating the support floor.
Precisely. And this leads to one of the most critical mechanics in all of charting, which is role reversal.
Role reversal, meaning what?
When a strong support level is finally broken and the price crashes through it, it automatically converts into a major resistance level for future rallies.
A broken floor becomes a new ceiling. And vice versa, right?
Yes.
Because if a stock breaks out above a $30 resistance ceiling and hits 40, the people who bought at 30 are sitting on a profit.
Right.
So if it pulls back to 30, they see it as a chance to add to a winning position.
And meanwhile, the traders who shorted it at 30 rush to buy and cover their positions out of sheer relief that they can finally escape at break even.
Oh, wow. So it's literally all just human emotion trapped in the price history.
That's all it is. And this is also why Edwards and McGee stress the rule of 3 for trend lines.
Connecting two reaction lows gives you a tentative line, right?
Yes, tentative. It's only confirmed when the price touches it a third time and successfully bounces. Each successful test reinforces the market's collective memory of that boundary.
Okay, but what happens when a stock is at all-time highs? There is no historical resistance. There's no memory.
That's when pure price discovery takes over. And that is why breakouts to all-time highs are often so explosive. There are no trapped sellers waiting to unload and break even. The ceiling simply vanishes.
Amazing. So we have these beautifully established lines of support and resistance. But what happens when the price just completely ignores them?
Gaps.
Yeah, like
Yeah.
when you wake up, the market opens and the price has literally skipped over the line, leaving a blank space on the chart.
Gaps are the ultimate tell. Edwards and McGee categorize them to filter out the noise. Because a common gap inside a sideways trading range doesn't mean much, It's just normal overnight volatility.
But a breakaway gap is a completely different animal.
Oh, totally different.
That's when it jumps cleanly over a major support or resistance boundary.
Yes. And it signals the violent initiation of a brand new trend. Anyone who was betting against the breakout is instantly trapped in a massive loss the second the market opens.
Ouch.
Yeah. You might also see a runaway gap mid-trend, which acts just like that flagpole measurement tool we discussed. But the one that traps the most traders is the exhaustion gap.
That happens at the very end of a massive run, right?
Yeah.
The price makes one final frantic leap, but then immediately stalls out.
It's pure emotional climax. The last holdouts who swore they wouldn't buy at the top finally cave to the FOMO and buy, creating this sudden short-lived vacuum of supply.
And then the smart money unloads.
Right. If the price stalls, reverses the next day, and gaps back down in the opposite direction, it leaves this little island of price bars isolated by gaps on both sides.
The island reversal.
It's a highly explosive signal that a dramatic market, top or bottom, has just occurred. The smart money has completely flipped the board on the retail traders.
Here's where it gets really interesting because you can't talk about gaps or any of these patterns without looking at the underlying fuel, volume.
You really can't.
You can have a perfectly drawn chart, but if the volume doesn't confirm it, it's a trap, isn't it?
Volume is the polygraph test of the market. The fundamental law is that trading volume must expand in the direction of the primary trend.
Okay, so in a bull market,
Volume should swell on the upward rallies and shrink on the downward pullbacks. That proves institutional capital is aggressive on the way up and refusing to sell on the way down.
think of it like a car trying to drive up a really steep hill. If the car is moving up the hill, but the engine is suspiciously quiet, well, that is a low volume breakout.
That's a great visual.
It's an illusion. The car doesn't actually have the horsepower to make it, and it's probably going to roll backward and crush you in a bull trap.
Exactly. If a stock reaches a new high, but the volume is visibly lighter than the previous peak, that divergence is a massive warning sign. The bull trend is running on fumes.
Okay, so let's assume a trader masters all of this. They spot the head and shoulders, they verify the volume divergence, they see the breakaway gap, they take the trade.
Right.
Human emotion can still completely hijack their decision-making. I mean, it is easy to say, cut your losses, but taking a loss actually hurts. People want to hold on and just hope it comes back. How did Edwards and McGee address the psychological risk of the trader themselves?
Hope is the most expensive emotion in finance.
That is profound.
They understood that the human ego simply refuses to admit it's wrong. So they made risk management mechanical. Analysis is utterly useless without a rigid system for preserving capital. The core of that system is the protective stop loss.
But they were strongly against using arbitrary percentage stops, like saying, I'll just sell if it drops 5%, which actually goes against a lot of modern conventional wisdom.
Because the market does not care about your arbitrary 5% tolerance. A stop loss must be placed at a technical point that logically invalidates the chart pattern.
Give me an example.
If you buy the breakout of a rectangle consolidation, your stop doesn't go 5% down. It goes just below the support boundary of that rectangle.
Because if it breaks that
If that boundary breaks, your initial hypothesis for the trade is proven wrong. You must exit immediately, without question.
and as the trade moves in your favor, they introduce the concept of trailing stops. You manually move that protective line upward, placing it underneath each successive reaction low as the stock climbs.
Right, so you lock in profit while still giving the overarching trend room to breathe. Combined with their rule to only risk 1 to 2% of total equity on any single trade, they basically created a mathematical survival mechanism.
Wow.
You can endure a long streak of consecutive losses without facing emotional or financial ruin, ensuring you're still in the game when the massive primary trends emerge.
So, synthesizing this entire journey, technical analysis isn't some mystical attempt to predict the future. It's a framework for observing the present. You are tracking the distinct footprints of massive institutional money, aligning yourself with the path of least resistance, and rigorously managing your risk when you're wrong.
It demands patience to wait for clear, structurally complete patterns. And perhaps more importantly, the discipline to trust the raw evidence on the chart over the talking heads on the news.
I want you listening to remember this the next time you turn on a financial network. When you look at those squiggly lines flashing across the screen, you aren't just looking at math. You are looking at a live feed of the hopes, the fears, the deep regrets, and the immense relief of millions of humans all playing out at once. It cuts completely through the noise.
It really does. But I'll leave you with this final thought. Edwards and McGee proved that human psychology drives these formations. Fast forward to today, and the vast majority of daily trading volume is executed by automated algorithms. The machines are making the decisions.
Okay, yeah.
If those algorithms are explicitly programmed to recognize these same human patterns to try and front-run each other, are the machines actually preserving and recreating 1948 human psychology in an infinite loop?
Oh, wow. That is a wild thought. The robots are just endlessly mimicking human fear and greed, trying to outsmart one another. We go looking for cold, hard, binary math, and all we find is the messy, chaotic reality of a mood ring.
The ultimate financial muddy waters.
Keep that in mind next time you see a chart. Thanks for joining us on this deep dive.